Today we are not going to discuss a trade that was featured in a book. We are not even going to discuss a trade that was executed by a professional investor. Sorry, Mr. Jones. In fact, we are going to discuss two trades that were made by yours truly back in 2015. To add specific details, I will also show you screenshots from my brokerage statements as proof. Oh, and one last thing. You may feel uncertain at first about where this story is going, but if you stick through, you should be pleased in the end. So please sit back, relax, and enjoy. I'm Nick, and this is Great Trades Revisited. The two trades that we will be discussing today involve Xerox Corporation and Avon products. Now, before we get into the actual trade executions, we should start with some backstory. Back in 2014, there were seismic shifts taking place in the commodities market. Specifically, there were dramatic changes occurring in the energy sector, which had led to collapsing oil prices. In fact, from July 2014 to January 2015, the price of West Texas crude oil fell from roughly $100 a barrel to under $50 a barrel. The three main reasons for this price collapse were reduced demand for oil in emerging economies such as Brazil, Russia, India, and China, the U.S. and Canada's emerging ability to collect oil locally through fracking and extraction from oil sands, and OPEC's desire to keep production stable despite increased production in the U.S. and Canada. You see, in light of the new production capabilities in the U.S. and Canada, OPEC desired to maintain their own production in order to create a net supply increase of oil. From this increased supply, OPEC expected to drive the price low enough to dissuade U.S. and Canadian producers from continuing their production. In this way, OPEC hoped to curtail the possibility of U.S. and Canadian energy independence. Now, as some viewers may be aware, the price of the U.S. dollar is inversely correlated to the price of commodities such as oil. This occurs because the U.S. dollar is the benchmark exchange mechanism for most commodities. So, for example, when the value of oil increases, it costs more dollars to buy that oil, which causes the purchasing power and price of the dollar to drop. However, when the price of oil decreases, as in 2014, it suddenly costs less dollars to buy that oil, which makes its purchasing power greater. Therefore, the price of the dollar strengthens relative to other currencies. As oil prices dropped into the beginning of 2015, the dollar rose rapidly. One of the most widely followed currency pairs, the USD-Euro pair, rose from around 74 cents in July 2014 to 92 cents in March 2015. Also, the USD-Real pair rose from around $2.22 in July 2014 to $3.24 in March 2015. Now, the ideas for my trades came as a result of these macroeconomic changes. With regards to how this affected U.S. companies at the time, any company who had a significant portion of their revenues overseas would be impacted by the stronger U.S. dollar, because the value of their revenues would be reduced when those funds were repatriated in the U.S. To be more clear, when those foreign revenues came back into the U.S., the effect of the exchange rate as a result of the rising dollar would cause the value of those revenues to decrease, thus affecting the company's profitability in a negative way. For this reason, I began to research U.S. companies who would be susceptible to exchange rate issues. I focused on companies whose overseas revenues accounted for at least 20% of total annual revenues. As well, I wanted to focus on companies whose overseas revenues were located in countries that had a significant currency devaluation relative to the U.S. dollar. The two companies that caught my attention in this way were Avon Products and Xerox Corporation. You see, over 20% of Xerox annual revenues came from European sales, while over 30% of Avon's annual revenues came from Brazil. Thus, I decided to buy put options going into these companies' earnings for the second quarter of 2015. But before getting into these details, I want to emphasize that playing a company's earnings is generally no better than gambling at the casino. But the macroeconomic backdrop in this scenario made the risk-reward worth it, in my opinion. To express these trades, I decided to use options since they were a cheap way to leverage my bets. As you can see from these brokerage statements, I bought 3 slightly out of the money put options on Xerox Corporation, which cost me $81.10, and I also bought 2 slightly out of the money put options on Avon at a cost of $90. As predicted, the effect of the strong dollar came to bear on both of these companies. Both stocks took a hit during their second quarter earnings as a direct result of exchange rate issues. Again, as you can see from these brokerage statements, I sold my 3 put options on Xerox for $420, and I also sold my 2 put options on Avon for $164. Thus, in the end, the return on the Avon trade was roughly 80%, while the return on the Xerox trade was roughly 417%. I hope everyone enjoyed this video, but if you hated it, I do expect to highlight another professional example in my next video. Thanks again for watching, and please remember that liking and subscribing are never expected but always appreciated. Take care, and I'll see you in the next video.